If you invest directly in the share market, then you may know that there are two other ways. They are mutual funds and portfolio management service, better known as PMS. The difference between the two is that mutual funds are not customized, while PMS can be customized as per the customer needs and risk profile. Now let us understand the difference between mutual funds and PMS and where should you invest.
In a portfolio management service, that is PMS, through Portfolio Manager, you can invest in shares, fixed income instruments, structured products and various other kinds of securities which are managed by professionals. Whereas mutual funds, on the other hand, are a professionally managed pool of funds received from investors which invest in stocks and bonds. However, when you invest in mutual funds, you don't get shares of different companies. You own mutual fund units. When you invest in a PMS, you own individual securities.
One problem with PMS is that a PMS has a minimum investment requirement of 50 lakh rupees. So it's appropriate for big investors, whereas a mutual fund SIP can start from as low as 500 rupees a month. Further, an equity mutual fund has to invest a minimum of 65% in equity regardless of the market conditions. In contrast, Portfolio Management Service (PMS) have the flexibility to increase or decrease the allocation to equity based on market scenarios and investor requirements. Now coming to taxation, mutual funds are better. Mutual fund investors have to pay tax only during the time of redemption, while in a PMS, investors have to pay tax as and when they sell securities and shares.
Now coming to returns, PMS provides better returns and sometimes higher as compared to mutual funds over the long term. Investors should also note that PMS has higher fees and taxes along with high returns. Further, the returns also differ from portfolio to portfolio.
The strategy in a PMS is similar to that of a mutual fund scheme. Why? It's because a PMS only releases model portfolios. It is referred to as a strategy rather than a scheme. Now the question is, what kind of investors should invest in a PMS? PMS strategies are usually more appropriate for experienced investors who understand how to manage risk and endure market fluctuations. They are for well-informed investors like high net worth individuals, HNIs and ultra HNIs, family offices and other institutions who have the money to manage risk and sustain ups and downs. Munjal Mehta, CFA, business head of Fortune Wealth and Financial Services says, and I quote, "One big advantage of PMS as compared to mutual funds is that the PMS provides customized fee structures and profit sharing models, whereas there is no such provision in a mutual fund. Further, investors see the exact quantity of stocks, dividends, fees, etc. in a PMS as compared to a monthly portfolio disclosure in a mutual fund. To decide whether a mutual fund or a PMS is best for you depends on various things like the size of your investment portfolio, how comfortable you are with taking risks, and where you want your money to go. Mutual funds may be a good fit for those with a modest corpus who do not want to deal with a high level of tax compliance. But if your corpus is in the 6 or 7 figures, requires customization and so on, then PMS might be your best bet.